Let's start with a little joke. What do you call a retiree who invests in gold and silver? A happy camper with a shiny future? Wait, okay, I can do better than that. Why did the silver investor break up with his girlfriend? Because she said she needed more space and he was all about stacking his ounces. Okay, one last chance. Why did the silver investor break up with his girlfriend? Because she said his stack was as good as gold. All right, no more dad jokes. Let's just talk about making sure your retirement will be as good as gold. Fine, okay, I'll stop with the jokes and the puns. I get it, you just can't handle that I'm punnier than you. Well, that intro clearly didn't work. Maybe I should just stick to the educational content. What is good, Stackers University? It's so good to have you here today with me. I don't normally do part twos of videos, but based on the comments, it was clear that you wanted me to talk a little bit about ounces and the ounces you need for retirement. And if you didn't watch the last video, I will link to it at the end. But in a nutshell, we talked about this idea of you needing to measure your wealth in ounces and real assets as opposed to dollars. So let's just dive into this idea of how much gold and silver you really need. As I shared, in our crazy world of fiat dollars, the only way off of this hamster wheel or out of the rat race is by measuring our wealth in ounces of gold and silver. In the previous video, I shared this quote from Mike Maloney, but let's focus on the last half of this quote where he states, ounces sort of determines how much you can buy in the future. How many ounces you need is almost like asking how many tacos are too many. It really depends on your appetite. But instead of tacos and appetite, it's all about how much wealth you want to protect. For those of you who like formulas for a more structured approach to answer this question, I would point you to the research that shows the optimum allocation to gold and silver is 20 to 30% of your portfolio. They came up with this range by running statistical analysis looking backwards to determine what would provide the greatest returns. I used to really believe this and follow this approach because it was logical, and the mathematical approach to answering questions is something I really like. Another formulaic approach is to estimate your annual retirement expenses, multiply that number by the number of years you expect to be retired, divide that total by the current price of gold, and you have your number of ounces you need per year. Or this at least gives you a ballpark figure of how many ounces you might need. But remember, that's just a starting point. Now, as I mentioned, I used to follow these kind of formulaic approaches, but over the last 5 years, my belief on this approach has really shifted to become more philosophical, and now I firmly believe that number should be significantly higher. While there are a lot of reasons, it all boils down to one major issue. We have to remember that when the facts or the conditions change, we have to take in that new information and determine if we need to adjust our position and or our approach. That beer virus of 2019 absolutely changed the world. And as we've watched governments just print and spend money like drunken sailors on leave, the debasement of our paper money and the resulting inflation is not over. And it's even more critical that we protect ourselves with real money and real assets. How do I know this? Just look at what the central banks are doing all over the world. They're doing the same thing. They're trying to limit their use or reliance on the US dollar by increasing their holding of gold. And now even Russia is flirting with the idea of holding silver. All of our lives, we've heard that the stock market is where you should invest your money. After all, the annual return has been a little over 10%. A 10% return sounds fantastic until you start to pull back the layers like an onion. The problem is that when we've all been taught to ignore the elephant in the room. The elephant is the devaluation of the dollar. We've all seen the visuals of how the dollar has been devalued and the resulting loss of purchasing power. Meanwhile, gold and silver had continued to appreciate, but even that appreciation is misleading because they are ultimately priced in US dollars. However, the real measure is what you can buy with that ounce of silver or gold. That same pre-1965 silver quarter that bought you a gallon of gas before, if cashed in for its silver content today, would get you about $5.50, which is about $1 more than what a gallon of gas costs today. So that silver quarter measured in today's dollars is about the same, but what it can buy you is more because a gallon of gas then is the same as today. So what has changed? The dollar. This is the clearest example I can provide to highlight why your wealth needs to be measured in ounces, because the dollar is just a floating extraction of value. That was the point I was making in the previous video. The only way you can really determine the value of real estate is by measuring it by the constant of gold and silver. An ounce of gold or silver are exactly the same. They never change. With that as our foundation, let's talk about this in the context of the stock market. While financial pundits are quick to point out the average return for the stock market is 10%, but if you're following me in my argument, then you've already started to think, but wait, that 10% is in depreciating dollars. So what is it really worth? Exactly. What they conveniently leave out is how gold and silver compare historically. As you can see in this slide, since 1972, gold has an average appreciation of around 8%, while silver is just behind it with 6%. In all fairness, over a year or two, that's not really a big difference. But over 52 years, that difference does become very significant. But does it really? Take a look at this slide where I calculated the 8% and 6% return on $10,000 in 1972, $10,000 in silver and gold. Those look like good numbers, but look at what that same 10K does at a 10% yield, and meaning if you invested in the stock market, that's $1.8 million, which would make you wonder, why in the world would you do anything other than stocks? But as Lee Corso says, not so fast, my friend. What is that 1.8 million really worth considering the debasement of the dollar? Well, if we just adjust that 1.8 back to $1972, we see that that's the equivalent of $247,000 in purchasing power. I'll admit that this is a little abstract, but the point I want to make here is that you're not as well off as the dollar amount would lead you to believe. But as we just established, a pre-65 quarter buys the same gallon of gas. Just like an ounce of gold in 1920 bought you a nice suit and a great night out on the town, a 1 ounce gold coin today does the same thing in 2024. So as we bring this all together, the powers that be have really tricked us into believing that the stock market is the best investment because we haven't been taught to look at the whole equation, which accounts for the dollar losing more than 98% of its value. What's the point of having a retirement plan that guarantees you $4,000 a month when that $4,000 buys you less and less every day because you're losing purchasing power every day? Gold and silver are some of the few assets that protect you against this insidious design feature of our current monetary system. If you believe things will get better, then you don't need to worry about having that much gold or silver. But if you think like I do, things are only going to get worse, then you need to get as much gold and silver that you can get your hands on. Before we move on, I also want to make reference to and highlight two key points that I haven't covered. One, I just want to mention that we also haven't even talked about the tax implications that go with that $1.8 million and the likelihood that taxes will be higher in the future than they are today. And two, with gold and silver, we don't have to worry about third-party risk, and that just can't be understated. Okay, now I do need to give a disclaimer. First, obviously, this isn't financial advice, and this should not be applied blindly. You need to work with a professional to determine the best approach for you. So before you go all Scrooge McDuck and dive into your pool of gold coins, remember that diversification is crucial. While precious metals can be a great hedge against inflation and economic uncertainty, they shouldn't be your only retirement strategy. I truly believe stocks are an excellent investment vehicle, but like any tool, it has to be used the right way for the correct task. For example, there's no way I would turn down or not participate in a company match 401k. Additionally, just like with stocks, there are better times to buy gold and silver, and that largely depends on where we are in the economic cycle. Ultimately, we want to buy more during the market lows and slow down our purchase during the market tops. If we remember that our wealth is measured in ounces, then we know that the answer to how many ounces is really about how much of your wealth and your purchasing power that you want to protect. For me, that's at least 50% of my retirement. Whether you're aiming for a golden nest egg or a silver lining to your retirement plan, see what I did there? Okay, never mind. Just make sure you do your research and make informed decisions. Remember, in the world of investing, knowledge truly is power. So keep learning, stay informed, and maybe, just maybe, your retirement will be as good as gold. Fine, I'll stop at the puns. You just can't handle this. In the comments section, are precious metals considered a core part of your retirement plan, or are they just kind of a bonus and supplement? Do you have an ounce or a percentage goal for gold and silver in your retirement? Or simply put an A+ in the comments to let everyone know that you always stack smarter and never stop learning.